Hello, my name is Sachin Prasannan, and my student ID is 24053613 for the module code MN0490. And I'm going to present on sustainable strategic decisions of PNG and its competitor Unilever. Next, I'm going to introduce the company which is Procter& and Gamble, also Unilever. They are global leaders in the consumer goods industry. They're renowned for their diverse product portfolios, extensive market presence, and strong dividend histories. The presentation provides a critical evaluation of the strategies across three areas. Basically, they are analysis and evaluation of investment for value creation, the role of board of directors in corporate governance and competitiveness, performance of socially responsible investment stocks, strategic business expansion in a reasonable framework. And I have used tools and theoretical frameworks such as Porter's value chain, agency theory, triple bottom line, SWOT, and Porter's five forces. So let's go over the company overview of Procter& and Gamble. They are founded in 1837 and they're among the world's leading consumer goods company. P&G operates in more than 180 countries and they have around 100,000 employees. And they have a variety of brand portfolios such as Tide, Gillette, and Pampers. And they have strong innovation culture and they focus heavily on R&D and they pursue acquisition to expand its market penetration. And also they have a strong track record of high brand recognition and they make sure they have premium positioning and market cost while escalating the production, and they face margin pressures in price sensitive or emerging markets. Next, let's go over the company Unilever. It was established in 1929 and also they are a key player in consumer goods as well. And it operates in more than 190 countries and they have around 128,000 employees. And they offer brands such as Dove, Lipton, and Ben& Jerry's. And also they have strong sustainability commitments in a global scale. And compared to PNG, which is Procter and Gamble, they have a lower R&D spending than PNG, and they have greater exposure to emerging market fluctuations. So next, let's go the corporate governance tiers and board composition. Single tier, which is common in the US and UK, and they have executive and independent directors on one board. Two tier, separate supervisory and management boards. For example, in Germany. And PNG and Unilever both have single tier board structure which is along the lines of US norms. But in Unilever, they did it after simplifying its Anglo-Dutch structure. And the board composition matters to reduce agency costs by aligning managers and shareholders' interest and incorporating diverse expertise for better strategic insights. Let's focus on the role of board of directors in corporate governance and competitiveness. Agency theory emphasizes independent board members to minimize conflicts of interest between executives and shareholders. Stakeholder theory, boards should account for broad stakeholder interest, including customers, employees, and communities, especially relevant for ESG integration. Next, we have a table which focuses on PNG versus Unilever in terms of board independence, key expertise, governance emphasis, ESG oversight, and diversity focus. PNG has 80%, whereas Unilever has 75% independent directors. PNG has uh, expertise in consumer goods, marketing, and finance. Unilever has it on sustainability and emerging markets and digital commerce. They emphasize more on shareholder returns in financial KPIs for PNG and in Unilever, multi-stakeholder sustainability and balanced KPIs. The ESG oversight for PNG is integrated but historically secondary to financial outcomes, whereas in Unilever, they they are central to mission, specialized committees for ESG and ethics. For diversity focus, PNG looks on varied experience, emphasis on brand and technical backgrounds or technological backgrounds, and Unilever prioritizes on sustainability savvy leaders and consistent with mission. Next, let's focus on the board competitiveness and recommendations. Board diversity. It encourages multiple viewpoints, reduce group thinking. In ESG linked compensation, uh, it aligns management actions with long term stakeholder interest. For governance framework, its benefit is that it ensures structured reviews of ESG and financial goals. Now let's look at the recommendations. With board diversity recommendation is expand directors with expertise in sustainability, digital commerce, and emerging markets. In ESG linked compensation recommendation would be to adopt a balanced scorecard approach, weighing financial and non-financial KPIs equally. And for governance framework recommendation would be to create specialized ESG committees to review carbon footprint and diversity and supply chain ethics. Next, let's look at remuneration and ownership requirements for both the companies. For PNG, there's a table for remuneration structure, ownership guidelines, disclosure and transparency, and recent trends. Well, in PNG, there's performance based. In Unilever, it's fixed plus variable pay, long term share hours linked to ESG and financial metrics. In PNG, executives hold substantial PNG stock, whereas in Unilever, senior leaders must hold mul- multiples of their salary in shares, aligning with stakeholder values. In PNG, US and their secretariat filings and proxy statement detailed compensation mix is done for disclosure and transparency. In Unilever, UK and corporate governance code compliance is integrated into the reporting for annual reports. In PNG, incorporating some ESG metrics into bonuses but still predominantly financial is for the trends, and in Unilever, stronger ESG weighing in executive remuneration to reinforce sustainability position is the difference. Next, let's go over the performance of SRI stocks or socially responsible investment stocks. Um, indicator, there's a table for indicator versus the PNG and Unilever. In indicator, we have carbon reduction, waste recycling, revenue from sustainable lines or methods. And we have social initiatives and investor perception. In PNG, there's over 45% over the last decade for carbon reduction, whereas in Unilever, there's 74% in key operations. In waste recycling, they do almost 85% of the products, but whereas in Unilever, it's 95%. And let's go over the revenue from sustainable methods or lines. It's almost 20% for PNG, and Unilever, it's almost 30% estimated. In social initiatives, clean water and hygiene programs, women's empowerment campaigns are done for PNG, and for Unilever, sustainable living, fair trade sourcing, NGO partnerships are done for Unilever. And in PNG, we have appearing in SRI portfolios overshadowed by Unilever's ESG reps. And in Unilever, we have top SRI pick, strong brand equity for sustainable leadership. Next, let's look at SRI related financial ratios of PNG versus Unilever. The cost of ESG initiatives by PNG is $1.2 billion, whereas Unilever is $1.5 billion. And we can see that higher sustainability spending can raise brand equity but compresses the margin initially. And in PNG, we have 10% of ESG linked market premium for this company, whereas in Unilever, 15%. And this premium reflects investor perception of sustainability leadership by Unilever. And SRI fund holdings, 18 percentage of that is of float SRI fund holdings, and Unilever is 22%. So it shows growing presence of ethical investment funds for both companies, and the difference in them is minimal. Next, let's go for the recommendations and reflections for SI performance. In PNG, expand eco-friendly product lines to target 30% of revenue from sustainable products by 2025. For Unilever, optimize sustainability initiatives through data-driven resource allocation and strategic supplier partnerships to maintain 50% of operational margins. Also, partner with leading ESG rating agencies and industry associations to implement standardized measurement frameworks across carbon footprint, water usage, and social impact metrics to increase investor confidence and compatibility. Also, balance quarterly performance targets with sustainable investment in ESG initiatives by demonstrating how environmental leadership drives customer loyalty, reduces operational risk, and creates competitive advantages in emerging markets. Next, let's look at the real option tools of P&G versus Unilever. Real options helps manage uncertainty in markets and sustainability regulations. For P&G versus Unilever, we have chosen expansion, abandonment, timing or deferral, and growth as the factors. In P&G, invest in new brands and product categories. In Unilever, acquires niche eco-friendly brands, invest in emerging market expansions. In P&G, divest non-care lines to focus on core consumer goods. In uh, Unilever, drop product lines not aligned with sustainability objectives. In PNG, staggered launches in new markets, test feasibility, reduce risk. For Unilever, defers large-scale operations if social or environmental conditions are unfavorable. And for PNG, R&D led incremental innovations, packaging, formula improvements. And for Unilever, emphasis on supply chain optimization, digital commerce, advanced sustainability technology. Next, we have the comparative investment analysis, and the metric uses EVA, FCF, R&D spending, and key investment focus, all in $1 billion. And PNG has 4.3, whereas Unilever has 3.1. PNG has 5.2 FCF, whereas Unilever has 3.8. And R&D spending is almost 3.5% of the revenue for PNG, and for whereas in Unilever it's only 2.2. Key investment focuses is on acquisition and innovation, whereas in Unilever it's sustainability efforts. P&G Investments has higher EVA due to strategic acquisitions and robust R&D, and they have a stronger FCF, allowing reinvestment in product innovation and potential new acquisitions. Whereas in Unilever Investments, they have moderate EVA, constrained by lower R&D and sustainability-related cost. FCF supports brand expansions, although significant ESG investments affect margin flexibility. Let's look at the analysis and evaluation of investments for value creation. For economic value added, we have measures of firms net operating after taxes related to its cost of capital, indicating whether true value is being created. For FCA, which is free cash flow, captures the company's ability to generate surplus cash after covering operating expenses and capital expenditures. For Porter's value chain, it assesses primary and support activities to potential value creation or cost reduction. These are the actionable recommendations for value creation. Enhanced R&D for sustainability. P&G direct more funding to develop eco-friendly products, whereas for Unilever boost R&D for to strengthen product innovation in emerging markets. To optimize value chain, focus on digitalization to manage supply chain uncertainties and reduce lead times. And for leveraging FCF for strategic acquisitions, acquire or partner with niche sustainable focused brands to diversify and address consumer trends. Next, let's look at Porter's value chain focus. Inbound logistics, PNG, centralized sourcing, technology driven procurement. For Unilever, regional supplier networks and emphasizing on local sourcing. Operations, PNG focuses more automated production lines, continuous improvement. Unilever, environment friendly manufacturing and energy saving protocols. For outbound logistics, PNG, global distribution centers, advanced inventory management, whereas in Unilever, lean distribution with sustainability targets or carbon offset. For marketing and sales, PNG focuses more on large advertising budgets, premium branding, and Unilever focuses on sustainability focused advertising and digital engagement. And PNG for services and support is product warranty and customer feedback loops, whereas in Unilever is ongoing sustainability education for consumers. Next, let's look at Porter's five forces analysis. For PNG and Unilever, the threat is moderate for new entrants. For PNG and Unilever, the bargaining power of suppliers is moderate. And for PNG and Unilever, the bargaining power of buyers is increasing because consumers demand better value, green credentials, and they compare prices and ethics globally. For PNG and Unilever, threat of substitutes is moderate because they want local and eco-centric brands which can disrupt for PNG, and Unilever, they direct local competitors to emerging markets. Whereas industry rivalry for PNG and Unilever is high due to mature market with multiple global and regional competitors. Next, let's look at the SWOT analysis. And the strength of PNG is R&D driven. In Unilever, sustainability leadership, global footprint. For PNG, weaknesses is premium cost structure, higher marketing. For Unilever, it's lower R&D and emerging market risk. Opportunities for PNG is plant-based products, digital commerce, and developing markets. In Unilever, opportunities is expand sustainable product lines, e-commerce, and local sourcing. For threats for PNG is commodity price inflation and intense rivalry competition. And for Unilever, it's regulatory pressures on sustainability and same as PNG is increased competition. Let's see the conclusion and actionable recommendations. For PNG, they focus more on R&D, and whereas Unilever, they focus on sustainability. Leverage partnerships. So they have to collaborate with tech startups, NGOs, local suppliers to share sustainability costs and embed local market insights. For regional customization, PNG should develop tailored products for emerging markets with local pricing strategies, and Unilever should expand digital channels to capture global e-commerce growth. And to balance near-term margins with long-term brand value, they have to incorporate responsible sourcing and sustainable packaging to differentiate in increasingly eco-conscious markets. And uh, these are the references. Thank you.